Hey guys, I trust you all well. I'm busy. I'm watching my chat box to get an indication that we're live. But I know we're live because we are past the time. I trust everyone is fine and that you're all good. And welcome to 2022. And it really is my most sincere wish that all of us prosper in this year. Compliments of the season to you, Kuda. And guys, if you had the opportunity to go on break, I hope you are fresh. If you worked throughout the season for whatever reason, didn't take holidays or it's not part of your holidays, I still hope you are all ready to go for 2022. Now, I'm freshly back in the market, a bit rusty. I hope it doesn't show on my face. But I think it's also important. I shared a little bit in the meeting that we had. I'm a guest speaker at Trading Buddies, and I just shared a little bit that it's important that you have a process that you manage for yourself when you get back into the market. Now, I find, after 3 weeks out of the market, I'm out of sync with what's taking place in the market. So I always need to get myself back in, and three processes, let's not call them little. Firstly, I would have spent time during the previous year, reflecting on all my strategies. And as I start the new year, if I'm going to keep trading the same strategies, I need to be absolutely clear that what I'm trading is what has given me the greatest returns. I've made the most money out of it in the previous year. So as an ongoing habit, you should be continually assessing your trading journal. Whether you write it down or you just use the information that the broker sends you, it's still perfectly fine, as long as you do serious analysis about it. So as I go into the year, last year, I made good monies. I made a ton of money out of my reversal strategies. I made very good money out of my pullback strategies. And, I made decent money out of my trading ranges. So that should be switched off. Out of my trading ranges. But when I had a look at it, I decided this year I don't want to trade trading ranges. What's the point of making decent money when you can make a ton of money, when you can create a lot of wealth? So why spend money on the strategies that, you're making fair returns? We want to create wealth, we want to extract as much wealth as we can out of the financial markets. That's the whole point of being in this business. So I'm very clear about that in terms of my strategies. And as we go through the year, I'll show you what I mean, but I don't trade trading ranges. Now, bear in mind, when I'm looking at reversals, most reversals are occurring out of some form of a trading range. Okay, but I'm trying to get in early into that reversal, and I'll show you some of the things that have transpired in this, almost a week and a half that I've not been in the market. Because I go back and say, hang on a second, if I started trading on the 1st of January or beginning of the year, where would I have seen the opportunities? Okay, so the goal is to trade less strategies. Doesn't mean I'll be trading less, because they might continue to recur. They might be quite busy, or they might not occur as frequently. It's perfectly fine, because when I get those setups, if I trade them well, I'm going to make a lot more money out of one move than I would make out of just jumping in and out and trading ranges, for example. So be absolutely clear about the strategies you're going to trade. If you're still going to trade the same, perfectly fine, as long as you have clearly reviewed that. Now, why am I harping on it? Because at the end of last year, in the last sessions, if you're in it, I started talking about money management. Money management is absolutely critical, because if you're clear about your strategies, and if you just trade them the way we typically are told to put 1% in, manage it, so you'll make money, but you're not going to make a ton of money. The gushers are not going to come your way. The gushers will come in when you have crystal clear strategy, but you apply money management principles to it. Now, money management is simply, that's the other thing that you need to have in mind. What is my money management strategy going to be for this year? So I'm starting off with so much cash. This is the equity that I have. How do I use that equity to create superior wealth? So at what point, so if I'm trading 1%, let's use that. At what point, how much equity do I need to have? So I've got X, I've got $1,000. Let's use that as an example to start with. And I'm trading 1%. At what point will I then say, okay, that $1,000 has now become so much? It's become 2,000 or 3,000, whatever the number, but you have to work it out. At what point do I go to 2%? Okay, because I've now grown my initial capital equity to a certain extent. And if that 1,000 becomes, make it up, 10,000, am I now prepared to put 3%? Strategies don't change because strategies are pretty clear. We know we've worked out on our strategies, you know the risk reward, etc., etc. But that all comes with understanding money management. Now, having understood when that happens, when your equity grows, how you increase the risk that you put in the trades. What happens if you have drawdowns? Okay, this is a business that we have. I'm constantly talking to guys and say it's part of the business. Okay, we will get drawdowns. It's a cost of sale. Okay, so if you have drawdowns occurring and you have a succession of drawdowns, your strategy is fine. So you're trading according to the strategy, but we don't know we know we kind of work out that at best we work at 60% probability, maybe if it's all super duper, 70, 75%, okay, on a particular strategy. But what happens if the 25% or 30% that you lose all come in a steady row? So that's a drawdown, then you're going to get your equities going to come down from that 10,000, whatever that is grown to whatever. Let's say it comes down to 6,000. You can't keep trading 3% or 2%. So what rules do you have to manage your equity and your risk when you have drawdowns? Now, this is a completely different part of the game that of how we trade that usually is not spoken about, simply because it's not complex, but it takes a lot of time to become aware of it, to understand. But we have to know that, because we don't just want to have a reasonably profitable business. We want to get into those huge returns. We want to be able to put our money into the market and get 2, 3, 4, 5 times returns out of it over, depending on what you trade in 5-minute time frame, over a day, 2, whatever. But that's what you want. That for me is a big focus in terms of what we'll start to talk through on this show. So got the strategies, we got the money management. The other thing that is entirely up to you is your psychology, your trader mindset. And I've said it so many times, and it's all on the records on the ATW shows. I've done some presentations on psychology. You have to know how to manage yourself as a person, as a being. Okay, let's put it that way. We all have different value systems, different belief systems, and guys that I coach, they know what I talk about in my own belief system. So this is an open show. I'm not talking about that, but I'm saying to you, you have to absolutely get to grips with your own psychology. Why do you need to do that? Okay, put aside trading. If you think of just your experience of life, the way you engage life, outside of trading, how do you engage life? When things go wrong in your life, what is immediate response? Is it I got a challenge that I'm going through, I'm sad, I'm unhappy, or whatever the case may be. But out of this challenge, I know I can grow, I can find ways to get around it. Or is fear, doubt, worry, anxiety what creeps in? and what begins to govern the way that you function. Now, all of that goes back to your own beliefs and value systems, and the way that you've constructed, for lack of a better term, the matrix out of which you live. So if you love movies, you might have watched The Matrix, The Resurrection. I enjoyed it thoroughly. But having said that, I enjoyed the first Matrix and the last one. There's all the other stuff they put in between. I didn't enjoy that. But anyway, suffice it to say, Matrix 1 really talks about this matrix that Neo lived in. And if you go watch that, or if you haven't watched it, we create a matrix that we function out of. And that matrix is governed by our beliefs and value systems. And it's up to you as a trader, if you want to make a ton of money, to fully understand that and make sure that your trading paradigm is robust enough so that when you come to the market and you're facing the market, you're not coming to fight and battle the market. You come in completely at ease, completely at peace, and you know that you're just coming in to extract the wealth that's rightfully yours. Okay, instead of coming in trying to fight the market, you will lose money, you get frustrated, get disappointed, and you give up. Or like most guys, that's now try and find this quick scheme, holy grail, get rich quick things. So strategies, crystal clear based on your history from last year. Money management, absolutely crystal clear. When you get to it, I'll recommend some books that you can read that you can get off Amazon, etc. And your trading psychology. Once you have all of that together, then we come and look at our charts and we start to look for the opportunities. Now, that's kind of the stuff that goes through my mind. It doesn't take one day. Opened my charts for the first time on Monday, and I was like, what is happening? Literally, I've got to rethink, refocus, and get back into the beat of the market. So always allow yourself time to do that. Hey, John, Happy New Year, buddy. So glad that you're back on this program. So with those three things in mind, what did I then do to get set up for the year? Okay, so I've got 7 markets that I'm trading. Now remember, the market is a market. It could be pork bellies, it could be bananas. It really doesn't matter. As long as there is a chart, we can trade it. It could be cryptocurrencies. As long as there's a chart. As price action traders, we can trade it as long as there's a chart. There is other ways to trade, of course, that you can learn from my colleagues. So you can go ahead and do that. But the first thing that I then did on opening my charts is this. Okay, I've already done it, and it should. Okay, so I've just opened the UK 100, derivative of the FTSE 100. So things have changed this year. So what I need to match, or the key levels that I need to put on my chart that remain permanent, okay, starting at the very highest time frame that I've got, is what was the high of last year, the low of last year. Then I want to find the 50% of that range, which is the midpoint of the range, because the 50% pullback of any trading range, whether it's a range of yesterday, the day, or if you have a news breakout and you have this huge trend bar, the 50% pullback is something that you must immediately mark, because the market may come back to that. If it bounces off that, so if we have a bear trend, market comes back to the 50%, bounces there, gives you a double top, gotta take the trade. Okay. If the market goes beyond that 50% pullback, means the bears that created that bear trend candle are no longer in control. So then you got to wait to see if we've got a breakout or a trading range. So 50% pullback in terms of the highs and the lows of last year are absolutely critical. Then, of course, I have my all-time high, and this light blue line was the low of the previous year, which would have been looking at as we traded in through 2021. So that's at the highest level. So I do that for every single one of charts I'm trading. There's some daily stuff which I'll talk to you about just now. So again, high of 2020, low of 2020, midpoint. Now, the high of 2021 for the Nikkei 225 was also the all-time high. So I just put that solid green line there so that when the market gets there, when I see it, I know there's got to be some reaction. Either we bounce off it or we accelerate through it, and I want to be prepared for that so that I can take the trades and maximize my profits. Okay, so I've got that. Same thing on the S&P 500. Okay, all-time high, low of 2020, high of 2021, the midpoint level. So we've had all of this acceleration, and we spoke about this a little bit, or quite a bit last year, that where the price ended up at the end of the year, not a surprise because of this huge pullback, which created a trading range. Okay, and the bulls breaking out above that one to get a 50% pullbacks. To full extension measured move of that trading range. That's why we have that reaction there. But all that's clearly marked for us as we get into the year. Same thing on the Hang Seng 50, high of last year, low of last year, 50% pullback. I just marked some stuff for me for yesterday. I'll leave it there. I'll show you when we get to it. Oil, same thing. UK oil, high of 2020, low of 21. Lowest price on this particular chart that I've got, 50% pullback, all marked in there. So once I've said this, I'm not going to come and worry about them again. I just know when I see a thick blue line or a thick green line or a thick red line somewhere down there, that there's a key level that the whole market is watching. So what we're doing with setting these levels, high, low, midpoint, even on the euro, what we're doing is we've got to remind ourselves that when you look at a chart, there are visible levels of support and resistance that we have to mark. If it's there on the chart, everyone's going to see it, the computers are going to see it, and we have to be aware of that, okay? Visible levels of support and resistance. But there are also invisible levels of support and resistance, which are critical, which the market tends to react to. And the one that we've already been putting in is this 50% of the last year's trading range, 50% midpoint. That's an invisible level, but it's there. The markets tend to look, when I say tend to look, this is close to 100%. There will be some kind of a reaction at a 50% level. There will be some kind of a reaction at a key level of support and resistance, highs and lows. So that's kind of that's the first thing that I actually do physically on the charts. Then, once that is done, then now you're just going to go down to the daily time frame. So by now, you've made a decision, or you ought to be thinking about the time frame that you actually trade. Okay, if you trade off any higher time frame, I know some of my buddies trade off the weekly and monthly, fantastic. But if you're trading on lower time frames, intraday, that's during the day, you got to decide which time frame you trade off and not jump up and down through time frames. Now, even say that I'm talking about the way that I trade. Some guys can trade multiple time frames in a day, but we want to simplify the way that we trade. Okay, we can use higher time frames to find key levels of support and resistance entries, but you need to be clear to say this is the time frame that I'm trading on, And when that's the time frame you trade on, stick to that time frame. Other time frames, higher time frames, or are to help you execute trades or manage the trades. So I trade off the 5-minute time frame. Okay, I used to trade off the 15-minute time frame. Absolutely enjoyed it until I got comfortable to drill down to the 5, and I'm super comfortable at the 5-minute time frame. The good thing is price action patterns. The patterns, the market is fractal. So the patterns that you see, that word fractal, Fractal, the patterns that you see will repeat themselves. So if you didn't have a look up here to say, hey, that's George on the daily or the monthly or the hour, you wouldn't know just by looking at the chart itself what time frame you are trading off. So it's not about, hang on, if I go to this time frame, there are a lot more opportunities, or rather the patterns are clearer than on this time. The patterns are the same. There are a lot more entries, of course, more trading on the lower time frames than you do on the higher time frame, but the patterns are exactly the same. So the next thing that I then do, because now I'm now saying, okay, I've set myself, I'm now getting to the mode of starting to think about where to trade. Okay. So now I go to the daily time frame, been away for the past 3 weeks. So I kind of look at the euro versus dollar and I say, hang on a second. Okay, man, the trading range that was taking place in December is persisting. Okay, so if there is a trading range, means the market gets to some high and then bounces off and comes back, gets to the midpoint and tries to go to the other way and then reverses again. So there is a trading range here and nothing has changed. So I look at it and I say, okay, unless I was trading ranges, then I would not be looking at this market. If I was trading ranges, man, what a beauty. All I got to be able to see is where is the market bouncing off. Then I need to just go to my lower time frame and look for those trades and trading ranges back into the middle of the range. Okay, so you could do that if you trade in the euro. That's something that you can do. So, for example, there is that high and that high slight break above it. The market is turning back. So you could simply say for yourself, if you trade in the euro and you see it's a trading range on a daily time frame, always now when we're going in to trade, you always need to mark the previous day's low of the previous day, and I just use red because it's low. If you break beneath that, bears are strong. Okay, I'm not being super accurate because of time, but you could actually go and make sure that the price is exactly that high. Okay, so you're setting yourself up for the day, low of yesterday, high of yesterday. Then, of course, the other key thing, 50% pullback. Okay, you just use the Fibonacci tool. Okay, so there is a Fib tool, draw Fibonacci retracement. That's what we use. And in order to get these levels, you just make sure that on the defaults, you've got, the 0, the 0.51, 1.5, and 2. Now, 50% pullback. I just mark it in a light blue. So thin line, light blue. Thin line, blue. Okay, so I have low of yesterday, high of yesterday, I have the midpoint. Then the other thing I'm interested in, of course, is now I go to the time frame that I'm trading and you click on your time frame that you're trading. So in this particular case, time frame is 5-minute time frame. So if you were trading this, the other thing that you need to put in the market is just the open of the day. Okay. Always, and in particular, because you are in a trading range, which means Market may break up, may just come, break through, come back and oscillate around there. Okay. So there is high of yesterday, midpoint, and the low is well down there somewhere. There is low of the day. Because it's a trading range, what are you expecting? You're expecting that the market will go at least to the midpoint of yesterday's range. We might break beneath that and close beneath that, but we're still within a trading range. So your goal, your objective, if that's the market you're trading, is to find ways to go short. Okay. And if you come into the market, into the this zone here, open of the London US session, assume you haven't taken any trades here. Now you've seen a lower high. Beautiful, see a lower high. But remember, we always see the pattern first. You see the pattern, but that's not what we trade. So we got to see, okay, there is my lower high, okay, which is also a lower low double top. It could have been a perfect double top, but it's not. Then all we wait for is now a pullback in the lower high somewhere in here. And if you get the lower high somewhere in here, then you must take the trade. But you must get a decent reversal, candle like that, you take the trade. Best place to put your stop is above here. Okay. So depending where you take the trade, 10 pip stop, at the very least, even if I see these 5 pip, unless I've already built some strong reserves, I always put a minimum 10 pip stop, and at a technical level. So if 10 pip was in here, I wouldn't do that. I'll go put it at the technical level. That's that level that we want. Okay, so that's the kind of way, you got to be looking at the resource files actively in the market today. That's how I'll be looking at it. So I'm getting more and more synced with the market. So I probably will be up and about tonight and trading tomorrow if things set up. But now the point is just to illustrate to us how you get started after being away for a while. Gold, done the same thing, monthly resistance, high, low, midpoint. So just to make sure that I've clarified, although you trade a lower time frame, okay, it's always critical to come to the daily. Okay, that's where you gotta see, is there anything else that I gotta see? Because you trade in intraday, so the support and resistance levels on the daily are significant. They will influence the way you trade. So don't just go and open your 515 and start to trade. After you've set up all these higher time frame levels of support and resistance, come down to the daily. Have a quick look at the daily. Okay, so when I was looking at my charts earlier on, that's pretty significant for me, that level, to see what happens when I get there. That's a significant market tender. So we've got a bit of a trading range, and I think it's a key trading range, because if we break above that, okay, the bulls would like to break above this descending trend line, okay, and put a close somewhere above there, whether it takes a day or two. That would be very significant, because they would have managed to attack successfully their previous lower high. But having gotten to that level doesn't mean that the bulls are in control, because then we just have some form of a double top, okay? And if we get some form of a double top, if you haven't taken any trades, I will be looking on the strength of that, looking to go short, okay, out of this level. That's what I'll be looking at on gold. On the other hand, assume the bears are strong and they're able to create a double top here, and they want to come and break beneath here. Okay, their goal will be to get there. Now, if that happens, if the market comes to here, I mean, this price here is nowhere where you want to go long, right, or short, until the market falls. Okay, the bears break beneath this. They're going to try and get to that full measured move. So the height of that trading range, they want to get to that measured move. Okay. And if the market gets there, what are you going to do? You can't jump in and say, well, let me jump in and start to sell, or let me just buy. You need to get more information, whether the market gets there or gets here. That would be a double bottom or a low double bottom. If the bears are strong, we have to get a second follow through candle. Okay. The bears are strong to break beneath this. We need to make sure that after the candle that breaks out beneath that, there is a follow through. If there isn't, possibly a failed breakout, wait to see whether this is just a double bottom and we get a higher low. Right now, in this trading range, which is forming here, you don't want to be jumping into any trades. You don't want to work too hard for your money. Let me put it that way. You can always take a trade and manage it scrupulously and make money. But let's wait market to get there. If the market gets there and you get a decent enough setup, man, we just jump in, get an early entry and manage our trade and make a lot more money than we would bouncing in and out of that. So patience is the key. Now, when you get to the daily level and start to use these measured moves, you start to get insight into hidden levels of support. So if we break above this trading range, 50% extension of that really gets us to that level, which is fantastic. We start to see if there's going to be a failed breakout, because then we want to just take it and trade it all the way down. If it just bounces around here, rather wait until you get clarity. You might get a double bottom, get bulls accelerating out of it, coming back and give you another opportunity. But do not ignore this descending trend line. That's key. We don't want to work too hard. We want to make a lot of money, but we don't want to work too hard. If I end up taking multiple trades, if it's a busy day and I'm just, got 4 or 5 trades across the different charts happening, that's good busy, but I'm making money. I don't want to be furiously busy, and end up the day with a couple of percent when I could have just waited for the next day and end up with, 10 times that reward. That's all the whole psychology that I was talking about earlier on. If everything is all set, you just come in, you're just at rest and peaceful and waiting. When it comes, man, you execute and just pull the wealth out. So I keep saying we're not here to make money. Okay, we're here to take wealth out. Making money is just too hard. Okay, so that's where I frame it for myself. We are here to extract wealth from the financial markets. And if we are here to extract wealth that is duly ours, then we don't panic, we're not rushed, we're not stressed. We wait for things to appear and then we execute. Okay, UK oil, Brent crude. Okay, so now, we've got all the setup, we're on the monthly. Now we come to the daily, and I just look at my chart and say, okay, no, that's interesting. That's the level that I would have watched. Because the point is the bears who created this gap down and this huge selling and some follow through, and they're going to defend that level. Bit of a reaction there. Nothing for me to jump in and trade as yet. So they're still hugging the 10 EMA. By the way, it's very important, just to recap. Pullbacks to the moving average are a strong part of my strategy. Okay, for years and years and years, I've just traded off the 20 EMA. And then in the past couple of years, I realized I can just put the 10 EMA by experimenting, and that closely approximates any trend line that I would put in. And the more I looked at the charts, it became clear that the 10 EMA exponential moving average is an indicator of the strength of a trend. So when there is momentum in a direction, the bulls or the bears, as long as price is above or bouncing off the 10 EMA or below if it's bearish and pulling back to 10 EMA, I want to be in those trades because that is a strong part of the trend. Okay, when the market breaks out of the 10 EMA, I very quickly put my 20 EMA on, and I also trade pullbacks to the 20 EMA until the market breaks that, then start looking at trading ranges, etc. So what you see here, this solid blue line is the 10 EMA. You could at any time just go and plonk in the 20. Okay, so there's the 20 EMA, which is pretty useful for the lower time frame. So with the UK oil now presently, I'm very, very interested to see what's going to happen at this level. Okay, there's that double top, bit of a reaction, still in a strong part of the trend. But if you just look at it, I mean, we're not getting successive bull candles. We're getting bull breakout, doji, pullback. Okay, so that might carry on, but that seems to indicate to me that this is just a trading range pattern. So I'm very keen to see when we get to this level, which is also close to the high of next year. My mindset looking at oil is I am looking to go short. Okay, so I'm going to keep on looking at it, and if I get a setup within here, that's what I want to jump into. I want to jump in and go short as early as possible. So that will be kind of my reversal point, right? Jump into that if I get the setup, and then trade it as it goes lower. If it goes lower, then look for those pullbacks to the moving average. So having done that, jump to our lower time frame chart. Okay, so skipped a step. Low of yesterday. Low of yesterday. High of yesterday. Then 50%. And you go down to the trading time frame. And what I'm interested in is just have a quick look at the open of the day. Okay, so I just leave my charts like that. Then you can move on to anything else. Hang Seng 50. Daily time frame. Okay, that's I spoke to you earlier when I had that marked on. High of yesterday, low of yesterday. Something interesting about this, of all the markets that I trade, the only one that I think so far in this year, in the past week and a half, that created a beautiful setup would have been the Hang Seng 50. And I'll show you just now very quickly. 50% extension. Now just by doing this before we even drill down, Okay, so this has moved for the day. It's moved quite aggressively. Gone past the 50% extension, close to this level. This was the breakout level of the trading range, and the market tried to test that. So that's a key level that the market is looking at. So we have this huge acceleration by the bulls, and they're coming to that level. So, if not in there, there's nothing to worry about. Now, what you got to wait for is, where is today going to close? Because that's going to give you a clue. Okay, if today closes way above this level, and also just slightly above the full extension of yesterday's trading range, what do? Do you come in tomorrow and jump in and try to go long? No, you don't do that, because we always look to the left. Okay, what's happened to the left? Because that gives us a clue as to what the market may do. If the bulls are strong and you really want to jump in to longs, and you're not in any of these, then you gotta wait for strength, breakout above that level. Because right now, if it turns, it's just a trading range. Okay, this acceleration could be just to test that level. So what we need to do when today closes, we need to see where it's closed. Okay, then we need to wait and see what's going to happen tomorrow. If it's closed above this, the bulls are strong enough. They will give us another acceleration. Then there will be a pullback, and then we can trade that. Okay. If the bulls are not strong, then we're just going to get a bear reversal here, a two-bar reversal or a doji candle or whatever. And if we get that based on this strength, then it will be worthwhile to start looking for shorts. Okay. I don't want to be jumping into a trade that is coming to this level of resistance. If at all you wanted to jump into this trade, early today, if you had seen it, would have been good, aiming for that. Okay. But I think the best opportunity would have been down here. This was the low of last year. So if you'd been trading right from the beginning of the year, you'd have already plunked the low of last year. You would have seen all of this price action to the left. You would have seen this wedge. We always talk about the wedge as the completion of a pattern. Okay, so that would have been the end of a pattern. Then you would have seen a higher low. Best to wait and see if there's then a pullback. We didn't get that. The market came back and gave us another double bottom. Now, in terms of looking for reversals, either you look for a reversal somewhere within here. Okay, so you would have seen that before all of this happened. This was at the end of the year. And then coming into the new year, that would have been a higher low. You would have seen that. Fell break beneath that. You would have seen that attempt to test that. First opportunity, if you're trading a reversal strategy, the first opportunity would have been to see if you can pick a reversal trade when the market starts to turn on that day. That's if you trade in the reversal trade. A little bit more interesting in terms of my strategies, pullbacks to the moving average, higher probability, 60-75% in terms of probability of success. And then, your rewards, depending on how you manage it, 2-to-1, 3-to-1, etc. Reversal strategy, very key to understand that they are the inverse. If you trade in the reversal strategies, there's a lower probability of success. We're talking of 40% probability of success, which means 60% of the times you will be wrong. Doesn't mean you lose money. If you know how to manage the reversal trade, you would break even. But of that 40% that you succeed on, if you manage it well, then you're getting into this huge moves here, provided you don't get stopped out, depending where your stop is. But you might continue to build up your position. So that would be the first opportunity. If you did not get that opportunity, or if you traded, you got stopped out and said, I'm going to wait, then having clearly seen that reversal, you have to look for an opportunity there. Okay, off the break of that, which again is some form of a reversal. Market opens to pull back. You have to be able to jump into that trade. If you didn't get into that particular trade, that's a decent enough bull candle. Now, I'm talking about entries off the 5 minutes. You don't put your stop here if you trade in the 5 minute, you have to go into the market, look at the open of the day, see where it reverses, and put your stop appropriately. That would have been another opportunity. The next day, no, this is not a trade that you take because it's a dodgy candle. You don't want to go and initiate, and it looks beautiful now, yesterday, but that's a big no. We don't go and look for opportunities of dodgy candles on our time frame. We wait, and then we pull it up from there. Guys, I have reached the end of my time for this session. Really look forward to seeing you again next week. There's some exciting news that Paul Bottrell will announce for us in terms of some of the things I'm bringing to the market on the ATW platform. So keep a listen out and you'll hear it in future. Thanks, Gary, Tan, John, Kuda. Really appreciate your feedback. We'll see you guys next week. Thank you to the guys in the office. Thank you very much.